Good morning, fellow option traders. Welcome to the daily scan for Monday, March 25th, 2013. All right, so Cyprus appears to have a deal to keep their banks open. Not a very big, what's Cyprus, the size of the island of Manhattan or smaller or something like that? But still an important precedent, I think, for how they're going to handle bailouts in the European Union in the future. So they have come to a tentative agreement, and maybe it's a firm agreement. So, the market has reacted somewhat favorably this morning. So as you can see here, the Dow, everybody's kind of up here pretty good. We're still waiting for the S&P500 to break through that all-time high, or not. The VIX on Friday closed at 13.57, and just to let you know, the VIX actually is the implied volatility of the S&P 500. So if you want to know what the volatility of the S&P 500 is, you can look at the VIX. And there are other tradable products on the volatility of other major indexes too. I just off the top of my head don't remember what the symbols are, but you can go ahead and just you can Google it or Bing it or whatever your tool of choice is. Gold is still keeping its nose above the waterline at 1600. Oil is at 94, creeping up a little bit, not much, pretty much behaving for the most part. And gas is still below $4, natural gas. All right, I wanted to first off, let's go take a look at at our accounts right now. The one that I was worried about, which was Amazon, I think it was Amazon. Well, before we get into that, let's take a look at the announcements for today. Nothing really happening. We have a Dallas Fed manufacturing survey, which is not all that big of a deal, and Uncle Ben is going to has his double speak here at 1:15. So they don't even have anything. They all know what he's going to say anyway. They just like to listen to him, I guess. Or he likes to listen to himself. Let's go back to our current positions. Insurance policies, still waiting for them to pay off. This one has expiration date of this Friday, so may end up being a total loss. I may get out of it before. See, that's the thing about calendars, is that you can. I'm going to be taking a look at this today, and let's take a little bit of a closer look at it ourselves, because I got some more information about calendars over the weekend. So we're looking at positions here in the quarterlies for both quarters here. Now, what we could do is possibly roll these shorts that are going to expire this week into one of these other expiration periods, and I will be looking at that, because the nice thing about calendars is that you don't really lose all that much money on them. We're only down $70 here. That's not a big deal. So there is a possibility of closing these two shorts here. Let's just take a look and see what would happen if we just did that analyze closing trade. Alright, so then we would be left basically with our two long puts, and then we could And we would actually be able to, it's going to cost us 6 cents to close these, but can we collect something at those prices at 87 and 91? Let's see here. Let's do 87 and let's do 91. Come on. Alright, so it's going to cost us 25 cents to buy these back, which would give us a risk profile that looks like a normal long option, in this case long puts, and then 87 and 91. These are worth a buck. These are worth quite a bit of money here. So we're going to attempt to basically pay for those by doing some more 87, and we would be selling these, and we would be selling the 91s also, and it would be 2. So we can collect 18 cents and 56 cents on this if we do this, and then we end up with a chart that looks like this. Well, that's not real pretty, is it? And that doesn't look like a calendar. So there's something wrong there. It doesn't look like the way that it should. And I'm going to have to figure out how to repair this. And I will do this today, and I will report back to you. This should be an easier roll than what I'm seeing here. So we'll let you know either that, or we'll just close the whole thing so we don't have to take the max loss. And we'll hide simulations here. And I'll only lose $70 on this, and I'll show you how I have an idea for another insurance policy. And alright, back to the monitor tab. The rest of these insurance policies expire out in this one in May and this one in April. So we don't have to worry about those. The only other position that I was a little worried about is this Amazon Iron Condor, and we got a good, if I remember right, Amazon did a good thing for us on Friday, so it moved back up. Gave us almost like on the weekly chart here, almost a doji type of a symbol. And we're hoping that it continues back up today, but we'll keep an eye on it. The rest of them are behaving very nicely. If we look at the Profit 10 portfolio by itself, just our Iron Condors, we have a delta of 21. Positive delta, which means there's some downside risk here, but not really worried about it too much. 21's a very manageable number, in my opinion. Alright, so I wanted to cover another type of insurance policy that I'm thinking about here based on what I learned over the weekend watching a seminar from Thinkorswim. And I wanted to show you, this is on the Russell. RUT is a symbol. And this is a calendar that I'm thinking about, and it's really, I'm only buying one option, one lot on each side of this. I locked in the prices based on over the weekend. I'll lock them in today based on whatever may happen today, and then we'll watch it as a simulated trade for a while and see how it works out. And again, if we're looking at a June or a May for the short, so a May expiration, so if we go to May 18, okay, so here is our probability here one standard deviation in the shaded area, so there's a good probability that it may drop down in here. But there's something else that I wanted to show you that could be very interesting and something that you should look at if you're doing calendars. Definitely if you're doing calendars and almost any other option trading. And that's today's option stats. I haven't looked at this very much, and the reason why is most of the stuff that I look at is after hours. And if I remember right, in the past, if the market was closed, there was nothing in here. So all the numbers were all zeros. But now I think they're just retaining the stats from the day and holding on to them until the market opens the next day, which is a good thing for me and you if you're an after hours kind of analyzer. So the key here is this current IV percentile. Now what this is saying is that the 52-week high is 32 and the 52-week low is 13 for implied volatility. And what it is saying now is that we are in the 17th percentile for implied volatility. And if we look over here at the composite for each of these expiration periods, we are well below 20. Well, except for the shorter the weeklies here. But if you're looking out at standard, looking out into where you might put a calendar, May, June, July, out here, it's pretty dang low. We're talking about 16 or 17. So based on that, and a high of 32, and we're at 16 or 17, and the low is 13 or almost 14, we're in the bottom of the IV percentile, and volatility is very low. And that's a good thing for calendars if you expect volatility to rise. And the other thing that I wanted to point out is when you're looking at an increase, say they say that volatility, let's take a look at the April expiration. If they say volatility could go up 1%, that's not 1% of 17.59, that's 1 point. And that's the way it is always expressed. So when we say volatility goes up 1%, it's going up an actual percent. So it's going up to 18.59, not 1% of 17.59%. So I wanted to clarify that. And that's important because when we come down here to the risk profile, let's go back here for a second. We're looking at, what do you think is reasonable here? If we're at 16, we're looking at May and June, we're at 16 and 17%. And if they're saying that we're really in the bottom of this percentile range, well, I would think that, a reasonable, if there's a little bit of a pullback, a reasonable increase in implied volatility would be 5%, don't you think? I mean, that would bring us up to 21, which is well below this 32 for the last 52 weeks. And we know that there have been some pullbacks, and I think that the VIX has gone up to around 40, and we could take a look at that on a chart real quick. Over the last 52 weeks, let's zoom out here a little bit. So we're talking between here and here, our highest was 27. All right. And I'm going to find out what the symbol is for the Russell for its volatility chart. But back to the Russell, so a 5% increase is not really all that crazy, right? It can happen. So we click on our wrench down here on our risk profile, and we bump this up 5%. Alright, so now we are looking at something that's going to cost us about $1,500, I guess you could say. And it definitely, looking at this white line, which is the current date, and it's March 25th, and we move it out to say like a month from now. Just looking at the white line, not looking at the max profit, just the white line, we're talking about $1,000 on a $1,500 trade. Definitely a possibility. Not saying that it's going to happen, but definitely a possibility. So we're going to watch this one for a while. Reset the parameters here. And that's if the Russell stays exactly where it is. We don't have to do anything. We're just going to make some money, that's all, and we definitely do like that. So that would be a pretty good trade if we think the market is topping. It's a pretty good trade even if volatility doesn't increase at all, because if we push it out another month, we're still talking about $300 gain if it doesn't do anything. But if volatility drops, well, that could be painful. Here's what happens with a 5% drop in volatility. And that would be, kind of painful. Still only a couple $100, but you can see if price rises and IV drops down to the bottom of its range, that could be a little, kind of a loser, I guess you could say, but still not all that bad. Is it worth the risk? Yeah, I think it is, but we're just going to watch it as a simulated trade here for a while, and we'll check into it. I'll find out what the symbol is for the RUT volatility gauge, and we'll move from there. All right, now let's do our scan for today. I'm going to skip the ones that we are in. So we'll jump right over to Apple. All right, we were looking for a pullback here, an alert on that, and that is no longer valid. And we may end up having basically a trend reversal here. So we're just going to keep an eye on that and see how things develop there. Let's squish these down a little bit more. Move this down here. All right. So we're going to be watching that for a new target. I'm going to take this alert off of here. All right. Amazon, Baidu, CF, Chipotle. All right, Chipotle, our trade last week failed, and we took max loss on that. That was a 1-to-1 risk reward. We were willing to risk our 250 to make 250, and we lost on that one. Sometimes you do. Not afraid to admit that. Is there anything else setting up? Well, there could be something setting up here. It doesn't always work out. It would have been much prettier if our stochastic would have continued marching up. But let's take a look here and analyze this trade a little bit here. If we would have been looking down here at the MACD at this time, we would have seen that there's really a lot of momentum leaving, and there's not much momentum there right now. And on the long term, actually, I'm going to move this back up here so we can just see this a little bit better. On the long term, we're also running out of gas, I guess you could say. So we might be kind of looking for a trend reversal trade here, maybe something up around here. I'm going to make a note of this for today to take a look at Chipotle, and maybe I'll do like a 20 delta up here. Let's take a look at what that might look like and where we would do that. So let's take a look at they're at 24% tile. So they're a quarter of the way up on normal implied volatility, and here's the range. Okay, April? Probably would do in April with a bear call at around 20. Well, I might do 23 here. Let's take a look at what that would look like. That would get us our 92. And maybe just do something a little bit different. Maybe finance some of that with a delta around here of around 10. And we would not be changing our buying effect at all. We might even drop a little bit lower on that. So basically what we would be doing is an iron condor with a lot of room for downside movement here. And we'll change this back to April. So I think this looks like a pretty good trade. This would give us our over $100. It'd be an iron condor. It just cost us another, I pay $1.25 per contract, so that would cost us another $2.50 to put on the put side of this, and a pretty low delta. And we could go even lower. 270, 265. That would still give us $119. Plenty of room for this to move down. And if it moves against us, we can still hang on to the bull put and get out of the bear call side of this. So I might be doing that today. So 325, and this would be CMG. Okay, let's take a look at, go back to the monitor tab here. We are not in Salesforce. We'll take a look at them. Oh, we got a nice pop-up here. And remember, this alert went off here. I believe I had an alert on this, and it scared me in the morning, scared me away from it. So this might be a good thing to do the same thing on, not necessarily a weekly, but to do a similar kind of a trade. Looks like we were looking at this last week. I'm just take it off and start from scratch. Same thing. This would be a bull put, so looking at April expiration, something with a little bit over a 20, right at 20 vertical, 67 cents, and then on the call side turn it into an iron condor with something around here with a delta of 10. So we would almost get our buck on that, and we would have lots of room for movement. 195, never have been up there on the call side, and 165 on the put side is way down here. So I think that would be pretty safe iron condor. And the reason why I'm doing that is, I can put on this other side and collect a little bit more credit and not have it do anything to the buying effect. So that's a nice thing to do. So we're going to do the same thing on CRM. Okay, this is already 24 minutes long. I'm sorry that it's going so long. What else we got here? IWM, MasterCard we're in. Netflix we're in. Priceline and Panera, we are in all of them. Alright, I'll get back to you. Maybe I'll just put it on my comments when I get to it, or on my description of this video, on what the volatility index is for the Russell index. Okay, so that's it for right now. Thanks for your patience. Thank you for watching. Have a great day and happy trading.